Okay, let's repeat again quickly on the chapter 15, the bonds. Why the company wants to issue bonds? Because they want to borrow money for the long period of time. And in the meantime, they to pay interest for the money that they borrow. Bonds is a very kind of secure type of loan backed with a contract. The bonds have the principal value, which is maturity, par value, or face value, maturity date, on the date which the borrower must pay back the principal amount, and coupon rate, which is the rate that is used to calculate the interest payments on the bonds and every period where the bonds has to be paid. You have different type of bonds. The bond interest rate is the one who's going to determine how we're going to issue or how much money we're going to get for the bonds when on the day of the issuing. The interest rate on the bonds tells you how much the interest the bonds pay to the bondholder once the company bond issuer borrow the money. Now we have two scenarios. In order to compare where the bonds are, we have to see what the effective market rate is, or the market or effective rate, or either it can be called effective market rate, is at the time when the bonds are issued versus the interest rate the bonds paying versus the market rate. There always going to be difference, most likely. Always going to be difference because, as you can see, the market fluctuate, and once the bonds are issued, you cannot go back and change the interest rate. That's why it's important for you to see what's the rate on the bonds and where is the market rate. So simply, there's one way to compare is the rate. If the market rate is higher than the bond, the interest rate on the bonds, that means the bonds has to be issued with a discount, because nobody's gonna want to invest in your bonds if you're paying lower interest than the market. And if the bonds are paying higher interest than the market, then you can sell the bonds with a premium because everybody is going to want that bonds since they give you high percentage. So the other way to look, some of the questions are given that with the bonds are issue, if we have a face value 1,000, they issue for 1,000. That means the bonds are issued at par, or at maturity value, or a face value, or the principal value. If the bonds are issued for 980 and the bonds are for 1,000, that means we have a discount. And if we get in more than the par value of the bonds, or $1,015, then we have a premium. That's how simply you can think of the bonds. Again, you're always comparing the market rate with the interest rate which is paid by the bonds. If both interest rates are equal, then you're going to get exactly the amount what stays on the bond. If the market rate is higher than the interest rate on the bonds, then you're going to have a discount. You have to issue the bonds with the discount to attract the investors. And if you're paying high interest rate than the market, then you can ask from investors premium. So the other way to the bond price is if you see it as a percentage or as a number. So if $1,000 bond is quoted at 100, that means 100 is the percentage. So the bonds are issued maturity value. If you see 1,000 bond quoted at 101.5, that means 100.015%. That means the bond was issued with premium. And if you see the number below 100, that means the bonds are issued with discount. 100, look at the 100 as a 100% or as a 1. 1, as you already know, is 100%. So above 100 is premium, below 100 is a discount, 100 equal, that means whatever you issue, or what's the value of the bond, that's how much money you're gonna get. The present value idea, we already talked about it. The present value is what's the current value of something that you're gonna receive or you have to pay in the future. Now, who's gonna receive it? That will be the bondholder gonna receive something, and the bond issuer is the one who have to pay. Since we're on the site on the bond issuer, for us, cash always gonna be outflow. For that reason, we're gonna look for the present value of the future payment. The question is, on the bonds, what do we have to pay? If we borrow the money, obviously we have to pay those money back, which is called the principal. We have to pay the principal back on the future date. And in the meantime, during the life of the bonds, we're gonna have to pay interest. So there's two cash streams attached to the bonds. One cash stream is the future value that we have to pay somewhere in the future as a lump sum over a period of time. Let's say after 10 years, we have to pay back $1 million. In the meantime, the second cash stream is the interest that we have to pay on that 1 million, which it can be once a year or can be twice a year and can be every quarter. How many times you're paying the interest, that's how much you're going to determine how many payments of the interest you're going to have during the year. So what's important for us? Important for us is the amount of the future payments, length of the time of the investment, interest rate during the period. The interest rate simply will be, if we have to simply talking about the bonds, that's, let's say, the bonds are for issue for $100 million with the coupon rate or interest rate attached to the bond 6%. At par, that means whatever the stated value of the bond is, that's how much cash we get. And those bonds will mature in 10 years. In the meantime, we're going to pay the interest, 6% interest. We're going to pay it semi-annually. So that means twice a year we have to pay the interest. How much interest will be that? 6% of $100 million for next 10 years. So every payment date on the interest, we have to pay $3 million. So $6 million per year. And at the end of the bonds, when the bond retired at year 10, we have to repay the bonds back, the whole amount. We saw what's going to happen if the bonds are issued between the interest date. If that happen, whoever get the bond, he has to, lend you the money for the bond, plus he has to pay the interest for the month that already expired between the payment dates on the time that he lent the money or get the bond, become a bondholder, because on the payment date he's gonna get the entire interest, not only for the period that he hold the bonds, but for the entire period which covered the interest payment date. So, for example, if the bond's paying interest every 6 months, and somebody bought the bonds on the 5th month after the payment date, 1 month after the payment date, or he has 5 months left to the next interest rate, he's going to pay us the interest for 1 month. And at the end of the period, he's going to get the interest not for 5 months, for the entire 6 months. So he's going to get his money back. That's why for the time being, we're going to consider the money that we're collecting from the purchaser as a bonds payable, interest payable, which interest payable is going to clear with the first payment. And that's payable is going to disappear from our balance sheet and it's not going to appear anymore. So now when we issue the bonds with the discount, obviously once we get the less cash, that means we're short on the debit. So we have to add more debit. And then that's why we're debiting discount on bonds payable. and we're going to create the bonds payable with the entire amount of the bonds that we have to pay after, in this case, after 10 years, I believe. Yes, 10 years. And if once we have a discount, the presentation on the long-term liability, now that discount is always going to work to going together with the bonds payable. And in the balance sheet, always you're going to show the net amount, the bonds less the discount. If it's the opposite, if we have a premium, then we're going to receive more cash. Bonds payable still going to be the amount of the bonds, in this case, $1 million. So we're going to be short on the credit side in this case. That means we create a premium. Credit side more like look like we making money. Yes, in reality, yes, you can say that. But it's on the bonds, it's not called gain or anything like that. It's called premium. On the discount, it looks like we're losing money, but it's not losing money because it's going to be called discount. Now, what we're going to do with this discount and premium over the time of the bonds, we have to amortize those one. So we can bring the value of the bond, the net value of the bond at the maturity value of the bonds. Now, the presentation for the bonds with the premium is going to be the bonds itself plus the premium, and that's how it's going to be shown on the balance sheet. And obviously, that net amount slowly is going to start reducing until become $1 million. So for the amortization on the discount and premium, one way to do it is the straight line method. On the straight line method, there's nothing scary. You just divide it by the discount be divided by the periods of the bonds and amortizing every period that amount. Looks like the straight line amortization. And technically, it's on the property, plant, and equipment. It's pretty much the same. There's no difference in that one. It's equal to the discount and the premium. More interesting on the premium is the same. You're getting the amount of the premium divided by the number of the payments, and every payment you're amortizing the exactly the same amount. And that doesn't change. So now what's the interesting? As we saw last time, the interesting part was the effective interest method amortization. And the effective interest method amortization is required by International Financial Reporting Standards. So if you see me in 332, Intermediate Financial Reporting second part, then we're gonna come back to this again. And we're gonna talk about amortization schedule on the bonds and effective interest rate. Now, effective interest method. Now, accounting standard for the private enterprises, which this course is under, allow the effective and the straight line method. That's why we, as educators, we have to show you that, hey, there's a straight line method as well. Again, the straight line method is very straightforward. Getting the difference divided by the number of payments, not the number of years, number of payments of interest. Every time when you pay the interest, you're amortizing the same amount. Now, what are the journal entries? Once we issue the bonds, the journal entries never gonna change. That's the interesting thing. Only the amounts of the only two amounts gonna change. On the effective interest method, the interest expense going to change, and the discount on the premium or the amortization of the discount or amortization of the premium is going to change. Those are the two amounts. The payment amount never going to change on the interest. However, if using the straight line method, then nothing is going to change. You're going to have exactly the same entry period after period, period after period. So if you're using the accounting software, you can literally put in those recurring entries and just make it there, and just every period when the payment comes, automatically make the system to post it, and that's it. We're done. Questions so far? That was everything up to this point is a repetition from last time. Any questions so far?
No, bro.
No, just give me 1 second to work on my nose, and we're gonna continue.
Okay.
Okay, I got this covered. So we can continue. Can you guys hear me? Hello?
Yes.
Yes? Okay. Now I start the host sound in my ears. Start sounds funny, different than before. But let's go. So effective interest method. Again, we have this example on the Excel spreadsheet, exactly the same example on the Excel spreadsheet. Let's take a look on the Excel spreadsheet to see how exactly is. I'm gonna open this Excel spreadsheet and I believe not this one, not this. Trying to figure out which one is it. This is the one. Okay, let me share my screen so you can see it. This is the exact scenario. And now how we get this this number. This exact number again is once we have the bonds, very quickly here, I'm gonna delete this one. Once we get the face value of the bonds, $1 million, interest rate that the bonds paying, we calculating the interest payment per year. Then we checking how many times per year those bonds paying the interest, and they getting paying the interest semi-annually, which means 2 times per year. Then we divided the annual payment into 2 on the days that the payments are made. Then we checking the interest rate on the market. Sorry, that's the period that the bonds are going to be outstanding, and that's 5 years. But since we're paying the interest twice a year, that means we're going to have 10 payments over the life of the bonds. The market interest rate is currently 6%, but since we're having 2 payments per year, that means for every payment, we have to apply 3% interest on every payment. So with that, now we're seeing that technically, over the life of the bonds, we have to pay at the end of the 550 year $1 million, and on the time being, we have to pay for those 5 years every year. We have to pay $50,000 interest, which is $250,000 interest payments on those bonds. Now the question is, what's the present value of those two streams of cash? So how are we going to calculate it? We're going to use the formula function, and we're going to go to financial. We're going to choose the present value, or PV, and we're going to start plugging the information. First one, asking for the rate, which is the effective rate on the market, not the rate that your bonds paying, the rate on the market. So since we have it directly for every interest payment, it's 3%. Next, I'm going to ask you for the total number of payments over the life of the bonds. That will be 10 payments. How much is the payment that every time we have to make on those bonds? That will be $25,000. And since we're making the payment, that's a negative for us, which is cash outflow. The last thing that's going to ask is, what's the face value or the future value that you have to pay at the end of the period on the life of the bonds, and that's $1 million. And since we have to pay it, we're going to put it negative. And when we plug those numbers, when you click OK, it's going to give us the number, which is 1 cent difference than this number. So if I simply go here and reduce the decimals, I'm going to get exactly the same number that they get. So what that means to me, what this number means to me, that means that today, if I issue the bonds, I can get only the amount of the present value of the two streams of cash that investor. So every investor will be willing to pay me $957,349 for 10 payments of $25,000, and after 5 years, $1 million I have to pay. So those one today worth $957,349. And that means we're going to get that much cash. We're going to issue, and we're going to have a bonds payable that we have to pay $1 million after 5 years. And we have a difference on the debit side. That means discount on the bonds payable. That's how we get the discount. Back to slides. This is for the discount again. Now, what's going to happen if we have to pay if we have to pay the interest? Now, on those bonds, let's go back to the Excel spreadsheet. Once we issue the bonds, unfortunately, the time is going to start rolling. If we issue the bonds on January 2nd, the first payment on the interest is July 2nd. So on July 2nd, we have to pay interest. How much interest we have to pay? We have to pay $25,000 interest. Now, question is, how much is our interest expense? And our interest expense will be equal to the outstanding amount of the bonds, or 957,439, times the 3%, which is represent the effective interest rate. Because that was the amount that was outstanding from January 2nd to July 2nd. And on that amount, we owe interest. How much interest? 3% for the half year. And that's why our interest expense, as you can see in this case, will be higher than the cash that we have to pay. The difference is going to go to start amortizing the discount on the bonds payable. the whole idea is through the life of the bonds, you have to bring the amortization, the discount amount, through the amortizing that discount down to zero. So what's interesting on this thing, on the discount, as you can see here clearly, now the discount, if we have a tier count, the discount's gonna start with, let's put here discount on bonds payable. That, and this is your debit, and on this side is your credit. So this account is gonna start with a debit balance. When we issue the bonds on January 02nd, we're gonna start with a debit balance, which is equals 42,650. Now our objective is again to bring this balance down to zero. And the only way I can bring this balance down to zero will be, that's my objective, this one to be zero one day, ending balance to be zero. The only way to bring debit balance down to zero is to start plotting credits. So every time when we make a payment of interest, that will be on July 02nd, and then on January 02nd, we have to amortize something, which on the July 2nd will be this amount, then on the next month will be that amount, and then we start adding those amounts, which is the difference between the interest expense and the payment, and that's gonna bring this 42,659 down to zero. And as you can see, the discount from 42,659 going down to zero by continuously deducting or adding on the credit side the differences. That's what we're gonna do. And that's what we're technically doing with those journal entries. And at the end of the 5th year, what we're gonna have only one account. The discount on the bonds payable will be zero, and the companion account will be bonds payable with exactly $1 million. Because don't forget, the presentation on the balance sheet will be bond payable minus the discount. It's gonna give you the balance on the balance sheet. Bond payable at the end of the life minus the discount, it's gonna give you the amount that's there on the balance sheet. And slowly, that amount's gonna go to $1 million, which is exactly the amount that we have to pay. Now, what we can do with this table is, let's say, for example, for some reason, you wonder, is this table accurate? You may say, am I making mistakes on the table? The question is, can you check yourself? And the answer is yes, you can check yourself. How can I check yourself? Well, simply get this table. I'm gonna move this table a little bit down. I'm gonna copy it, but the way it is, and I'm gonna paste it as a value. So this is my table, literally. Let's make this one here, and that's a 0 here. And let's make those numbers a little bit more useful, like this. And that's my percentage. So I have the table. And I have, this is the year 1, at the end of year 1, at the end of year 2, at the end of year 3, at the end of year 4, at the end of year 5. So now the question is, how can I get this balance? Can I get it somehow somewhere else on ROA? Yes, you can. What we need is a little bit adjustment on the information that we have from here. If I copy and paste this, I'm going to show you now. If you copy and paste this is the amount of the present value if we have 10 payments remaining. Well, how can I find this amount? Where can I find this amount then? Well, this amount, it will be if there are only 9 payments remaining. So if I change this one to 9, I should naturally get this amount, not 957,349. I should get 961,069. Let's check if that's true. If we reduce the payments with 1, the present value is exactly equal to that amount. Then how can I get the next amount? Well, reduce one more payment, go to the 8th payment, and then you're gonna see this is the ending balance at the first year. How much will be the balance of the second year? Well, once you're here, check how many payments left. 1, 2, 3, 4, 5, 6 payments. So if I bring this one payments to 6, I should naturally get this amount. And you're getting it. That's how this formula works. So what if I have 0 payments? If you have 0 payments, obviously, you went down to the original amount or the face value of the bonds. Why? Because you pay all the interest. So no more payment of the interest, so the value is exactly the what is the maturity value of the bond. If you're having 1 interest payment remaining, that will be amount. If you have 2 interest payments remaining, let's make it this one with the decimal so you can see exactly match. If you have 2 payments remaining, that will be the amount. If you have 3 payments remaining, that will be the amount. So the number of the payments here on this calculation is going to give you the balance on the bonds. Make sense? What will be at this point, if you have 3 payments remaining, what will be the discount remaining to amortize? Obviously, the discount always going to be the difference between the face value of the bonds and the present value of the bonds. It's going to be 14,143,061. Wait, can you see? This is on this chart on the balance of the bond. So on the bonds we already amortize 28,507 on the original value of the bond from the 42,651. We amortize 28,508, and that's how much left. That's how easily you can match moving from one direction to another direction the bonds. In 332, I'm going to show you if you have no idea about the market interest rate, for example, and you have only this amount on the present value of the bonds, how can you get the effective interest rate? But that will be in 332 intermediate financial reporting, if I catch you there. So let's go back to the slides and let's complete the slides today with this. So that's how you're getting the interest payments here. So if we have to go to the table, the one that we prepared with $1 million, again, the interest payment never gonna change. That's why you have to be certain about, because we have a contract to pay that much interest. Now the interest expense gonna change. Why? Because the value of the carrying amount of the bonds changing means going up. If that amount going up and the interest stays the same 3% only, that means the interest expense naturally gonna start increasing. The difference between the interest expense and the interest that you actually pay as a cash, it's gonna go as a amortization of the discount that you have at the beginning until you bring the discount down to zero. And the only thing that you're having is the carrying amount on the bonds payable for $1 million. And here is the explanation on which one, which column, what exactly you're doing. Now, what we can see is why the effective interest method is used is because the effective interest method consider the time value of the money and slowly decreasing the discount on the bonds to bring the value down to the carrying amount of the bonds. So we're starting with 957 and then we start increasing the carrying value until we reach $1 million. In the meantime, interest payment stays the same, but the interest expense increasing. That's what we can conclude from this chart. Now, if we have to do the same thing with the premium, with the bond premium, again, we're going to get this question when the market value is 4. And I'm going to flip you just for a second to the Excel spreadsheet, just to remind you where you can find this one. You can find it on the premium worksheet, premium 3, I believe. This is where we have this scenario here. Now, if you ask me, how did they get this amount? Well, that amount, again, if I have $1 million bonds, which paying 5% annual, 5% per year, but they're paying the interest 2 times a year. So every time when they have to pay the interest, they have to pay $25,000. Maturity is 5 years, but since they have to pay the interest twice a year, that means we're going to have 10 payments of interest. Market rate is effective, current market rate is 4%, but since we're paying the interest 2 times a year, so the interest rate attached to every payment will be 2%. Once we have that information, then again, we're going to the formulas using the financial functions, scrolling down to present value, PV, and we start plugging the information. A rate is always and always market rate. Which market rate? On the every single payment. Number of periods is number of the payments that you have to pay using the exactly the same percentage of the market is related to. Payment is the amount of the interest that you have to pay, 25,000. And since you're paying it, it's an outflow for you, so it's negative. Future value is the maturity value of the bonds. And since we have to pay, that's a negative 1 million. And that brings us to the present value of exactly the same number, which is given from the publisher. Now, when we plug this number to our amortization schedule, what we can see in this case. Now, we're getting more cash. We're clearly getting more cash. So that's called premium. Now, over the life of the bonds, same idea as a discount, we have to amortize that premium and bring it down to 0. The thing is, the carrying amount of the bonds, as you can see, is higher than the future amount that we have to pay. So what we have to do, we have to slowly start decreasing that amount until we bring it down to $1 million. So the check here is carrying amount of the bonds minus the premium has to give you the face value of the bonds. And if I do this, every time when I get the bond payable balance minus the premium, it's going to give me face value of the bond. So if I have to do the same thing as I did here with the discount on the bonds, what was it here? I would show you with the T account. Let's get this T account and move it here. Exactly right here. So this one is not going to be discount in this case, that's going to be premium. on bonds payable. And that premium now is not gonna start with the debit balance, it's gonna start with the credit balance. On January 2nd, in this case, we're gonna create, and we're gonna beginning balance will be create. That's how we're creating this credit balance. And over the life of the bonds, we have to bring this balance here, that's ending balance gonna come on this side. We have to bring that ending balance down to 0. How can I bring the credit balance down to 0? By adding debits. So for that reason, on the amortization of the premium, you have to add every period the difference between the interest expense and payment. And that's how you're gonna go, keep going. That will be your discount, amortized discount on July 1st, not July 2nd. Next one will be January 2nd, and keep going until you bring that premium, that's 44,912.93 down to 0. Now the same idea applies here. How can we get any of those amounts in the mid section of the chart? Change the payments that left. Here in this case, if I have 10 payments, that's my present value. If I have now, since this is active, if I change here the payments, everything is going to change here. So I have to do exactly the same thing that I did before. Let's quickly do it and test this one. Obviously, the result's going to be the same. I have to warn you, there's nothing new here. I'm not doing any magic or anything like that. And that was percentage. So if I grab this calculation here, and let's say if I want to find what will be my carrying balance for the bonds payable with premium after the 3 payments of interest. Well, how many payments, if I initially have to do 10 payments and I already done 3, how many payments left? 7. So if I plug here 7, that amount should be equal to that amount directly. And it is equal. If I have only 1 payment left, the balance will be exactly here, because only 1 payment left. And that's how you can check, are you correct in your calculations? Are you correctly applying this chart and these formulas? Obviously, the journal entry here, every interest payment is going to be, as account is going to be the same. Cash always going to be the same. The only thing that's going to change is the interest expense and the premium, which we're amortizing through the life of the bonds with every payment. Now let's go back to the slides. Let's stop sharing this. Let's go back to the slides. Oh, again, that's our premium. This is the journal entry. Now they changed here again, the premium is, so this is the cash that we're going to get. So every time when we pay the interest, 25,000, we're going to amortize, we're going to have our interest expense and we're going to amortize premium of the bonds. So now, the other thing that I forgot to tell you here from the chart, if we observe the chart, what we can see is the balance on the bonds, as you can see, slowly start decreasing. What that means to our interest expense. Since we're applying the same percentage, the interest expense slowly is going to start decreasing. Opposite to the discount. On the discount, the balance increasing, interest expense increasing. on the premium, the balance decreasing to reach 1 million, interest expense also decreasing. So every period we're going to have less interest expense and high amortization on our premium. Both interest expense and the premium discount will be on the debit side now. Why? Because we create the premium on the credit side. So we have to bring this balance down to 0. So again, if we take a look at the chart will be the same as we talk. This is the explanation of every column of the chart. And if you have to take a look closely, the interest payment is going to stay the same. Interest expense will be less than the interest payment, and it's going to going lesser and lesser and lesser, where the carrying amount of the bonds is going to start high and going down to $1 million over the life of the bond to catch this difference here between the interest expenses. Now, the current portion of the long-term debt, now that was with the bonds. We're not going to spend any more time on the bonds. On 332, in that course, I'm going to show you what's going to happen if we have a presentation day between the payments day. Now let's go with the current portion of long-term debt. Obviously, everything that has to be paid within operating cycle or 1 year, whichever is longer, has to be shown as actually this is the one that if we have to pay within the if we have the event of the year end and the reporting date between the interest payments. So we're not going to keep it to the next course. You're going to have to do it right here. So the straight line method, again, I'm not going to spend time on the straight line method, but just to give you an idea, if we have a reporting date, between the interest payments date, then we have to show the interest expense. We have to show the interest payable, and depends on how we issue the bonds or the discount or the premium, we have to amortize either if it's discount on the credit side, if it's premium on debit side, that portion. Now that difference between the interest expense and interest payable. And the next payment, when the interest payment actually happen, don't forget to clear the payables that you have created on the reporting date. On the reporting date, there's no actual payment of the cash. That's what you have to understand. The cash is not involved here. You just make a accrual for the interest expense, working with the interest payable. And on the payment date, you're closing first the interest payable. Second, you're adding the interest expense, clearing the cash, and the difference goes to the discount or the credit side if you have a discount, or on debit side if you have a premium. That's with the straight line. Now let's see how this is going to work if you have a effective interest method. Just a second, I still have to work on my nose because it's getting too much congestion. Sorry about that. Okay, so how are we going to deal when we have the effective interest method? Well, there's no difference between the general idea is the same as a straight line method. Again, we have to see where the reporting date is. And based on that, based on the reporting date, then we have to work proportionally on the journal entry to make it work. What that means is we're going to have the interest from the chart that we already created, the Excel spreadsheet. We're going to have the amount of the expense, the total expense. So we're going to prorate that expense over the period, either per month, either per date. You decide which way. And then you're going to see where the reporting date is. So how many, what's the period between the last payment of interest and the reporting date, and the reporting date to the next payment of interest. Allocate that amount proportionally and work on the numbers. So in this case, we're going to break if our premium is, that's total premium is 44,913. So basically what we're going to do is interest payable on our original journal entry. We're going to get 2/6 of the interest payable, 2/6 of the interest expense, and 2/6 of the premium. Now the interest expense, it's going to be applied for the 2 months only. Premium on the bonds is going to apply for the 2 months only. And now we're not paying cash. Again, we're not paying cash. We're just showing the interest payable for the 2 months. After another 4 months, when the payment date comes, we're closing first the interest payable that we created on the reporting date. Second, we're showing the other 4 months interest expense, 4 months for the premium on the bonds payable, and paying the entire cash. Simply, put it this way, is once you have this chart, now you know that this interest expense is is for the first payment, which it doesn't happen on the first month, it happens after 6 months. So this interest expense is for the 6 months. So what you have to do, if you have a reporting date somewhere in the middle, this is for 6 months, divided by the 6, get it per month. Divided by 6, get it per month. Divided by 6, get it per month. And then allocating the first months going to the journal entry, which is going to be, in this case, let's use this one. For example, if I have to break this entry by 2, let me do something so you can actually see it. So let's change this payment as the question. This is October 02, and this one is October, November, December, and then we have January, February, March. This is March 02. I'm deviating a little bit from the question. Okay, let's make it here more easily October 1st, and that will be March 01st. Those are the 2 payments. So basically, I have a reporting date right here in the middle. This. Actually, no. You know what? Let's do it this way. Let's leave the way it is. Move it here and create a new worksheet. So in this worksheet, I don't need this part. And I don't need this part. And we said here the first payment of was October 1st. And the second payment is March 01st. So here in the middle, between those 2 payments, I'm going to have year end, which year end is December 31st. Now, this is my entry that I have to make on March 31st if I don't have the year end. But now I cannot make it. Why? Because I have to split this entry into two pieces. So I'm gonna copy this and I'm gonna flip it here. This is what they have to split. Interest expense for that much, premium for that much, and cash for that much. Now I know the cash I have to pay it in March 1st. There's no way I to pay cash on December 31st. But on December 31st, I have to accrue my interest expense. So I'm definitely going to have interest expense and bond payable on December 31st. Sorry, not this way. It has to be this way. Definitely I'm going to have those two accounts. So I'm going to equal to this one. Now, the credit in this case is not going to go cash because I'm not paying cash on December 31st. I'm paying cash on March 31st. So that's going to be interest payable. That's what I have to pay on March 1st. Now, if we have to see how distant year end is from October 1st and how distant is December 31st from March 1st. So that's going to give us idea what to do with this amount. So from October, if we have to do October, November, October, November, December, January, March. We have 1, 2, 3, 4, 5, 6 months. Now, October 1st to November, that's 1 month. November 1st to November 30th, 2 months. December 1st to December 31st, that's 3 months. So what I have to do is I have to break this amount per month. That's one option. Get the interest expense and get the premium and break it per month. So how much will be my interest expense? It's gonna be this one divided by 6 since I have 6 months. And my premium is gonna be this amount divided by 6. So every month, October, that will be my interest expense, that will be my premium. And those numbers, they're not gonna change. Because at the end of the day, in March 31st, if I don't have the year end, my journal entry should be interest expense equal to 20,816.22, and the premium is gonna be 483. But since I have that year end, so then I'm gonna break it up to this point. This will be for one my entry, this is for my second entry. So I'm gonna get the total here. And I'm gonna get interest expense gonna be equal to sum of all those three numbers. And bond premium is gonna be equal to sum of all those three numbers. And bond payable simply will be the calculation between this one and that one. My first entry is done. Now the second entry, that's for the year end. Now I'm accruing my interest payable and I'm showing my interest expense and amortization of the premium, the bonds. Now March 1st, what I have to do is, obviously I'm going to have this. First I have to push this everything down. Now let's go with this. I'm going to go a different way. Let's insert this line and push it down. My first debit, before I forget, first debit, I'm gonna clear my interest payable, which I created on December 31st. And I'm gonna just clear it, 12,500, that one's gone. Then I'm gonna get my interest expense, which is for the next 3 months, from January to March. Then I'm gonna get my premium, which again is for the next 3 months, from January to March. and that should be equal to 25. Let's see if that's true. That will be this one plus this one plus that one, and that's 25. That's my payment on the interest. And that's how you're splitting this journal entry into two journal entries by using interest payable in the middle. So if you combine, if I combine, let's say, so those two, they have to be, let's cut it from here. Let's to be consistent. So if I have to combine those two, my interest expense is equal to the original interest expense. My premium discount is exactly the premium discount that I have to discount. So nothing has changed. I'm just breaking the entry into two pieces. Working with the interest payable in the time being, which I'm creating in the first place on December 31st and March 1st. I'm closing it right away. So if this is repeating year after year, you're always going to have the interest payment, clear payment. Then you're going to have two split entries. And then again, interest payment, split entries, and interest payment, split entries until the life of the bonds. Again, everything repeating with the same pattern. So let's go back to the slides and finish those slides. Now here on our bonds, they're doing only 2 months. That's why I deviate a little bit from the slides. I make it 3, 3, they make it 2, 4. 2 out of 6 going on the interest expense, 2 out of 6 going on the premium, 2 out of 6 going on the interest payable. On the payment date, you're clearing the interest payable first, getting the interest expense 4 out of 6, premium on the bonds 4 out of 6, and the cash is 25. You're not changing the cash. And this is the logic between how you're getting for the 2 months versus 4 months. If we have to use the same logic, our for the 3 months that we did it, it's going to be equal, but totals always going to be the same, like a normal journal entry without year-end in the middle. That's why it's important you to get the chart first, and then everything is easy. And now, what's going to happen if we have to retire or convert the bonds? Retirement of the bonds, then we have a few scenarios here. One scenario is to the wait till the bonds actually retiring at the maturity date. The other option is to retire the bonds early. To retire the bonds early, we can purchase the bonds on the open market or the current market value, or exercise if we have a callable option. Callable bonds may be the call by the issuer. Now, whoever issued the bond, he can call the bonds. That's why it's called callable. Redeemable is the purchaser can redeem the bond, or the purchaser, whoever held holding the bond, can go back into the issuer and asking, I want my money back. Now, the journal entry in both cases, callable or redeemable, is exactly the same. What's interesting with retirement of bonds earlier before the maturity date? First, we have to do some calculation. Same thing like a property, plant, and equipment, selling the property, plant, and equipment. The first thing that we have to do is we have to bring the amortization schedule up to date. Means that if we have a premium, and they're definitely going to have the premium and discount, we have to bring that premium and discount up to that day which the bonds are sold. So we're going to have, obviously, we're going to show the interest expense. We're going to show the discount on the bond premium. Then we're going to write off the portion of the premium discount, which is related to the end of the period of the bonds. And then we're going to calculate, is there any gain and losses? Calculation of the gain and losses is the last thing. So let's see the scenario. First thing first. 10 million bonds, callable bonds with unamortized discount $40,000 are retired. They're gone. So the market price is 99.5. The callable price is the one that we actually have to pay, is 903. So here the question is which option the company is going to choose. Obviously, it's going to choose company is going to choose the cheapest option, which will be to use the market price. If you go on the callable price, we have to pay more. Now, if we go with the market price, then what we have to do? We have to clear $10 million bonds, which still have a discount left, 40,000. So the carrying value of the bonds is $9,960,000. We paying 99.5. This is the cash that we're paying, or we're paying $9,950,000 for something that's sitting in our books at $10,000 more. So basically, we gaining here on the retirement bonds of $10,000. That's how we calculate it. So how we gonna do the journal entry? First, we're gonna close the bonds, 10 million. Those bonds are gone. Second, we're gonna close the remaining of the discount, 40,000. Then we're gonna pay the cash, and then we're gonna balance the entry with the gain. What's gonna happen if we have to pay more? Well, we're gonna balance the entry with the loss. Now, if according to the accounting standard for the private enterprises, if we retire the bonds earlier and we have abnormal in size and unusual amount on the retirement, we have to report it as a separate line on the income statement. What's going to happen if we have a convertible bonds? Now, the bondholder has an option to exercise the bonds for the common shares. So basically, somebody can have a bond and then convert it to common shares. Why do we want to do that? Why somebody is going to borrow money, issue the bonds, and later on he's going to exchange the bonds for common shares? The only reason is if you do that, you don't have to pay the bonds. Let's say I borrow $1 million and issue the bonds, which paying 3% interest. After 5 years, I'm converting those bonds into common shares. Do I have to pay back the $1 million? No. I'm just moving the liability into the equity. Now, yes, he will become an owner of the company with the amount of the shares that this $1 million loan money worth, but I don't have to pay the $1 million back. Now, the bondholder has here opportunity to achieve higher gain from increasing the common shares value. Again, common shares value going to go up, and we can achieve that gain. Shareholders' equity will increase by carrying amount on the bonds which are converted, obviously, and the liability is going to decrease. So, advantages and advantages of the borrowing. Why people want to borrow and why people don't want to borrow. What's the difference between shares and what's the difference between bonds? Which one is the preferable, which one is not? Now, depends what the objective is. So, we have to see that the share, we have to remind ourselves in chapter 13 and 14, by issuing shares, you're giving up ownership of the company or equity, and shareholder becomes the owner. By issuing debt, you're not giving anything. he has the bondholder in this case, he's a creditor, but he cannot tell you what to do and what not to do. Which means that the ownership is not going to be diluted or decreased, and there's no risk of losing control of the company when you issue bonds. For the shares, the other thing is corporation is not obligated to repay the invested amount to the shareholders. So in this case, it's less risky if the company doesn't have money. So whatever you invested in the corporation by purchasing the shares, you're not going to see those money back. I'm sorry. However, if you lend the money, you get the bonds, the corporation has to repay those bonds back at the maturity date. Return. This is for the principal. So basically, if you invest money, let's say I have a $1 million. I have two options, to invest or to borrow. If I invest, I may not see those $1 million again. If I borrow, they're going to pay me back those one. In the meantime, what's the return that I'm going to get? Okay, the $1 million is my principal, which in one case I'm never going to see it. In the second case, I'm going to get it back. In the meantime, over the period of time, am I getting something? Well, if I invest in the shares, $1 million, which I'm never going to see again, $1 million, what I'm getting, I may get again, may or may not get dividend. Which means is if the corporation decides not to declare dividend, I may not see dividend at all. Where if I borrow the money, lend the money, the company is going to start paying me a regular interest. What's interesting with those payments? Dividend is paid after taxes. So dividend is not expense for the corporation. Where interest is deductible for tax purposes. If I can choose between shares and bonds, which I'm going to choose, most likely I'm going to choose to issue shares. Issue bonds. Why? Because by issuing more shares, I'm going to increase the number of shares, and my earnings per share is going to go down. Where if I put the interest expense on the bonds that they have to pay as interest, my earnings per share is going to be a little bit higher compared to if I issue common shares. What's the benefits? Benefits in the shares is I can raise a capital without increasing debt, where the bonds is you can create a return of the shareholders. If I leverage properly, means that if you paying 4% interest on the bonds, you make sure that you generating at least 10% return. So the 10%, 4% we paying interest on the bonds, so 6% you're keeping in the company. So let's see this calculation here. This is interesting calculation, and you can see it. You have two options. This company has net income of $600,000. $200,000 common shares currently outstanding. The company needs $1 million. Two options. One option is issue $1 million 10% bonds. Second option is to issue 100,000 common shares for $1 million. Let's see what's going to happen in each scenario. First scenario, borrowing the money. Net income before taxes is 600,000. Projected income, interest, and income tax is 300 in both cases. Before interest income, that's projected income before interest and income tax, 300,000. Now, if we borrow the money, we have to pay 10% on 1 million. That's $100,000. That's going to reduce our income before taxes to 200,000. Once we apply 40% taxes, which is 80,000, our projected net income will going to be 120,000. Now the company net income is 720. Now our outstanding shares are 200,000, so earnings per share is 3.6. In the other scenario, net income after interest and income tax before the expansion is 600. We're projecting to generate 300 more. But we have to pay taxes, 120 at 40%. Then projected income after paying taxes is 180. Plus the 600, which is currently half, our projected income is going to be $780,000. Divided now, not on the 200,000 shares, divided by 300,000 shares, because we already issued 100,000 shares, our earnings per share is $2.6 for single share. So as you can see, what's happened here? If we adding the interest expense, first, yes, our income goes down, but income tax also going down with $40,000. Can you see this? If we don't have 100,000 expense, we're paying $40,000 more on income tax. So effectively here, our the percentage that we're paying on the borrowing is not 10%. It's actually 6%. Because we are able to generate $40,000, adding $100,000 in expense, we saving $40,000 on taxes. Plus, when we adding the projected income into the current income, 600, plus, since we're not increasing number of shares, our earnings per share is higher. This is very interesting comparison between one and the other, and one day I really hope you have to do that decision. Means that you're on the level that you're running successful company and you're thinking, what will be the cheapest way for me to raise a capital? I strongly wish you to get to that point. Now, what other long-term liability we may see on the balance sheet? Mortgages. What's interesting with the mortgages? Mortgages is a loan which is secured by the real property. You borrow the money from the bank to buy a house, but you don't own the house. Banks own the house because the loan is secured by the house. Now, on the repayment, now you don't have to do this crazy schedule which I show you for the bonds, but you have to do a different schedule. And that schedule will including those blended payments. Now, what the blending means? Blending means combine two things into one. Means with one payment, you're gonna pay two things. You're gonna pay interest and you're gonna pay principal. Now, this is one example of the blended payment. Let's say imagine the mortgage signed on October 1st, 2023 for $200,000 for 10 years, 5% at 5%, with the monthly blended payment of $2,121. Now, payment never going to change, but that payment is going to be part of the payment is going to be allocated to the principal and part is going to be allocated to the interest expense. How much will be one versus the other? This chart is going to show you that. Now, can we get real pictures on the mortgages? Yes, we can. The only thing that we have to do is follow me here. Let me share my screen and we can do this together. Can you guys see my screen?
Yes, bro.
Okay, so what I want you to do is on your screen, when you go to the search engine, go to mortgage calculation. So once you click on the mortgage calculation, you're going to see so many different options, mostly from the bank. Forget about those one bank. Go to the Mortgage Calculation Financial Consumer Agency of Canada. Can you see that one?
Yes, bro.
Click on that one, and you're going to see this government official page from the Canadian government, which give you this mortgage calculation. So in here, we can put so many things. And they give you different options here. So first thing first is now we can go with the 30 years mortgage if you want, amortize over 30 years, but we're going to stay over 25 years. If your down payment is more than 20% of your home price, your lender set the maximum amortization period. There's some different things here. So if the down payment less than 20% of your home price, your maximum amortization period is 30 years. If you are first home buyer or purchasing the new build, 25 years in many other cases. But that will be the financial institutions. So now, what we're gonna do is let's go and check. Once we have this, let's go and check the price of the apartment. What we buying? Give me an example what we're looking for, and let's make it real scenario here, and in which city we're looking. Somebody give me some idea. Are we buying condo? Are we buying townhouse? Or are we buying house?
Apartment.
Apartment. So condo. 1 bedroom, 2 bedroom, 3 bedroom.
3 bedroom.
3 bedroom. Where? Vancouver, Burnaby, New Westminster, Surrey, Langley, where?
Vancouver.
Vancouver. For sale. Let's see what's the price for this one. Let's go random, go the first one, and see if we can find any prices here. That Vancouver Estate, that's not the real one. Rio, let's go with this one. So we have 3 bedroom, right? Let's go to 3 bedroom. And let's sort with the lowest to highest. So if we want 3 bedroom, 2 bedroom, 1,080 square feet condo in Yaletown. That's how much they asking. And let's we go a little bit down. That's where we're going. Now we're going higher. Then we're going to the 3 bedroom, 3 bedroom. This probably will be a little bit more realistic price. Cole Harbor, but this is very, very front line. So I'm trying to find some realistic. Mount Pleasant, East to Vancouver, Yaletown, 1,900,000. Which price? Which one you looking? Let's stay with this one. On Alberta Street. 1,895,30. This is the mortgage that we're looking for. 1,895. So the mortgage amount is 1,895,123. Actually, no. Sorry. This is not the mortgage amount. This is the amount of the condo, right? The bank's gonna ask you for 20%. You to put 20%. So that means you have to make a payment, down payment of 1,895,123 times 0.20. That's $379,000. You have to make down payment minus 1,895,123. So your mortgage amount is going to be $1,516,000. Now the interest rate. Let's check the interest rate. More. Canada or BC. And let's go with this one. Current mortgage rate. If we stay on the 5 years fixed, as you can see, 5 years fixed rate right now, they ask you 389, but this is insured. So we're not going to get this one. But we might get 5 years, a special for 389, 5 years fixed, insured residential 4. So let's stay with the 4%. That's kind of realistic. 4%, not 5%. Our interest rate is 4%. Amortization period, let's say you're a first home buyer, let's put the amortization period on the 30 years. Payment frequency. Now this is interesting because depends how you paying the, often you paying the mortgage, you're gonna have a different amount. Let's leave it monthly, and then we're gonna make comparison so you can see it. Term is always 5 years. We're gonna keep it those 4% of 5 years. After 5 years, we can change it. We're not gonna make any prepayments, nothing like that. We're starting, and let's calculate how much our mortgage was gonna be. So, if we have to buy that apartment, for which this apartment here, 3 bedroom, 1,651 square feet in Alberta Street, South Canby, we have to pay 60 payments within 5 years, or 360 payments over the 30 years. Each payment has to be $7,208.86. With that payment over the 30 years, we're gonna pay principal of $1,516,000, and we're gonna pay interest of $1,079,190. So in total, we're gonna pay $2,595,090. This is if we stay with this scenario. Now, if we go further, we're gonna see this mortgage summary. And if you go further, you're gonna see the diagram. If you go further, you can open this summary report. Let's open this summary report. And the summary report is gonna look like this. This is your payment amount. With the first payment, with the very first payment, first month, we're gonna pay $2,197, which is gonna go to reduce the principal. And $5,011 is gonna be our interest. And we can see in year 1, year 2, year 3, how this 7,000 payment is going to be allocated to the principal versus the interest. And as you can see here, let's see where those two are equal. What I'm seeing is here the principal still less. At year after 13 years, 150 months from now, from the amount that we pay, interest allocated, which you're allocating to the interest, and the principal is going to be equal. After that point, we're going to pay more principal than the interest. So it has to take 13 years. Now let's do something else. We're having this one, this is our base chart, right? So let's do something else. I'm going to duplicate this here. And let's do some adjustments in our calculation. Not here, we have to go back a little bit. And let's do slight adjustment to our calculation. Instead of monthly payments, let's move to the bi-weekly payments. And just leave it the bi-weekly payments and let's calculate what's going to happen if we're doing bi-weekly payments, not monthly, bi-weekly. If we're doing bi-weekly payments, our payment amount is going to be $3,325.63 per payment. Now, what's going to happen here? Interest we're going to pay is $1,077,990. So compare with the monthly payment, we save $2,000 on interest. So here we have to pay $2,595,000. In this case, we have to pay $2,593,000 just by doing bi-weekly payments. We reduce $2,000. So let's do something else. Let's duplicate again this one. And let's do our bi-weekly payments. Let's add prepayment amount every year or every payment or every year. Let's go to every year. We're going to put $10,000 towards our mortgage each year over the 30 years. Let's do the calculation now and see what's going to happen. Now the payment's not going to change. But the prepayments that we're going to make, we're going to end up paying interest of $852,687. Compared for not prepayments, we save $200,000 on interest. So here it says interest saving on the prepayments. We're saving $226,503, just adding $10,000 for our payments every year. And total savings in this case, so interest saving of non-monthly payments. So if we go with a non-monthly payment, we're saving another 1,000. So total saving is 226. And here is the mortgage summary, if you can see it. You have made 600 bi-weekly 2 weeks payments of 3 on one final payment of 261. You have early prepayments 10,000 starting period 1. You have paid this one. That much is the principal interest, and total you're paying that much. Over the 5 years, the first 5 years, because don't forget, every term is 5 years, and you can, after 5 years, you have to renew it. On the 5 years, what you happen? At end of the 5 years, your balance will be that much. So after 5 years payments, instead of we starting with the balance 1,560,000, after 5 years, your balance is going to be $1,314. So basically, you paid only $200,000 out of your mortgage. After here, you paid 201, but you're paying interest 280,000. The other thing, by the end of the amortization, with your early prepayments 10,000, you have saved 226,000, or interest on your mortgage of 66 payments sooner. So we're gonna have in this case 66 payments less. By the end of the term, with your early prepayments, you save only with the 5 years. Within the 5 years, our saving is 6,000. With non-monthly savings, if we go to the non-monthly saving, because we're doing the bi-weekly, by the end of the amortization, with your selection of non-monthly payment, you have saved $1,200 interest. If you have paid monthly payments. So by only doing bi-weekly, over the entire period, you're gonna save $1,200. Over the 5 years, you're gonna save only $120. So those are small tricks on the mortgages that I wanted you to see. And if you have to using this page, please use it. It's I found it very useful if you want to calculate, and then you can change here parameters and do whatever you want. The question is, okay, if I pay $10,000 prepayment, what's going to happen? Watch this. If we, let's say, if we add instead of 10,000, let's make it 15 prepayments. What's going to happen now? 5,000 more. You're paying only 5,000 more, and you save $306,000. If you save 5,000 more, in here your saving is 226. If you add another 5,000 in your prepayments, you're gonna save 306,000. So your saving is higher, $80,000. $80,000 you just save like that. Obviously, your payments instead of 637, it's gonna go down to 584. And you can check different scenarios here. What's going to happen, let's say, if the interest rate change? Let's duplicate this and let's go with the 3% interest. Then your payment's going to go down. And the total interest that you have to pay is 568. Compared to 4%, here you're paying 772 interest. In this case, you're paying 568. So you save $200,000 by making a good deal with the bank and securing the interest rate at 3%. Now, is this 3% going to stay over the 30 years? That's a different question. Because if that percentage first year you're getting 3%, then the 5 years you're getting 4%, and then going here, you have to get the average to see is the calculation goes and how the calculation goes. But this is interesting too. I find it myself interested. That's why I'm showing it to you, so you can have some practical application of these mortgages and how to calculate the mortgages with the blended payment. That's where I'm gonna stop right now. So basically, the journal entry on the mortgage, once you have the principal and the interest, what you're gonna do is the cash is cash, always gonna stay 2,121. The interest expense is interest expense. Principal amount going to reduce the mortgage payable. And that entry repeats every period. The only thing that changes is the interest expense and the payment and the mortgage payable. That's the only thing that's going to change. And then the mortgage always going to have the current portion, which is within 1 year, and the long-term portion of the mortgage. Okay, Do you guys want break?
Yes, Prof.
Okay, let's have a short break, and at 11 we're gonna continue.
Thank you, Prof.
You're welcome. Okay, can we go?
Yes, Prof.
Okay,
Yes, Professor.
let's go. Let's wrap this thing after the mortgages. The next thing is, which is liability also, is if the owner of the company lend cash to the company. Sometimes the owner preferred that way instead of investing in the company. Why? Because they can earn passive income in form of interest directly from the corporation. Again, on the other side, the owner can borrow money from the cash from the company. Why the owner wants to borrow the cash from the company? Because that way it's not considered withdrawal. And the owner can pay for the business expenses using the personal funds. That's another thing, which is also create shareholders loan. Now, the shareholders loan can be asset or can be liability, depends on what it is. Obviously, if the owner paid company expenses with personal funds, then the company owes him money. And if the funds are owned by the shareholder, that's become an asset for the corporation. That's with those. Now, the last thing that left on this chapter, the long-term liability, is the lease. Now, the lease, we're going to spend more time in the intermediate financial reporting second part, 332. But very briefly here, you to have some ideas on the leases, especially leases under accounting standard for the private enterprises. Now, lease is defined as agreement between lessee and lessor. Who is the lessee? Lessee is the one who's using the asset. Lessor is the one that who owns the property or the asset in this case. Agreement. There's agreement between those two people to make a regular payment in exchange of the exclusive use of the assets. There are two types of leases. Now, in the accounting standard for the private enterprises, identify two types of leases. One is the operating lease. The other one is the capital lease. In the International Financial Reporting Standards, that's completely different story. But let's stay with accounting standard for the private enterprises, two types of leases, operating lease, capital lease. Capital lease is further divided by two types, sales type of lease, direct financing lease. Now let's see first operating lease. Operating lease is the definition of the operating lease is if the lease is not capital, is operating. What's interesting with the operating lease is the short term, or also called cancelable. The lessee, the one who's using the asset, he's using the rights to use the asset with no condition, continuing rights onto the assets, only for the period of time. Lessor basically remains the risk and rewards of the ownership of the asset. So that lease is treated very simple for the accounting purposes. Debit expense, credit cash. Is it going to be rent expense on the lease expense? Then that's based on the entity or the company that you're working in. But in general, expense, cash. That's it. Nothing more, nothing less. Keep it simple. Lease commitment should be stated in the notes of the financial statement if there's any lease commitment on the short term. Again, this is short-term lease. And if there anything, there has to be stated on the financial statement. Let's see the other one. Capital lease. Capital lease is the one that's more interesting. Capital lease is means that the owner, not the owner, the user of the asset or the owner of the asset substantially transfer all the risk and benefits to the lessee. Lessor transfer the risk and the benefits of the ownership to the lessee. From the perspective of the lessee, the capital lease is if one of the following conditions are met. So basically, the definition for the lease on the accounting standard for the private enterprise is you checking the lease if it's capital. If one of those three is met, the lease is capital. If none of those is met, then it's operating lease. So any of the following are present at the beginning of the lease. First, there's a reasonable assurance that the lessee will obtain the ownership of the asset at the end of the term. If we have a clause that at the end of the term, the ownership of the asset will be transferred to the lessee, then become a capital lease. Second condition. Let's say first one is not available. The asset, it's not, there's no indication that the asset is going to be transferred to lessee or the lessee is going to have the ownership. So the second thing is, if the lease term cover 75% or more of the estimated useful life of the asset, then it's considered capital. What that means is very simple. If the useful life of the asset is 10 years and the lease term is for 8 out of 10 years, this condition is met. That means you're treating the lease as a capital lease. Let's say this one is not met. Let's say first one, there's no reasonable assurance that the asset is going to be transferred to in the hands of the lessee. Second one, the useful life is 10 years. We're using the asset only for 7 years. So it doesn't cover 75%, covers 70%. The third one, lessor would recover original investment plus earn a return on the investment from the lessee. So basically what that means is, if the asset worth $50,000, there's no reasonable assurance that the asset's gonna stay into the hands of the lessee. We're using the asset only for 7 years out of 10 useful life. But again, asset worth $50,000, that's how much lessor pay for it. But by the year of 7, over the 7 years, the lessor receive $65,000, which is more than he initially purchased the asset, then this is capital lease. So this is one of the following is present, and both of the following is present. Now we have another two. Credit risk associated with the lease is normal. So if the credit risk is normal and one of is met, capital lease. And the amount of any unreimbursed cost to the lessor can be estimated. If we can estimate that amount and the credit risk is normal, and one of those is met, then it's capital lease. What's the cost? Now, the lessee, or the one who leased the asset, must record the leased asset at the present value of the leased liability. Again, we go into the present value. Now, my emphasis on the lease, it's gonna be on you to know what type of leases we have under accounting standard for the private enterprises, which one is the operating lease, which one is the capital lease. What's the test for the capital lease? And that's where I'm gonna stop on the testing you. I'm not gonna test you in journal entry from the lease. We're gonna leave those one for when we go to the intermediate financial reporting. Bonds and it's more than enough for this. Lease, I'm not going to bother you with lease for time being, but I still want you to know which one is the operating lease, which one is capital lease. Means operating lease, remember, expense, debit, expense, credit, cash. On the capital lease, there's a condition that has to be met in order to meet the capital lease. If those conditions are met, capital lease. So now what's going to happen is you have to record the leased asset at the present value of the lease liability. So we're checking the lease liability. So basically, and the lease cost of the asset is the sum of any payments made at the beginning of the lease period. So the interesting thing with the lease compared to the mortgage and compared to the bonds is that we're paying the interest, the payments that we're paying on the contract are paid at the beginning, not at the end of the period. Same thing like a rent of the apartment. The rent is paid at the beginning of the month, not at the end of the month. And the other one is the cost of the asset of the lessee is the sum of the any payments made at the beginning of the lease period and present value of the future lease payments. Now the lease payments are equal to the amount which happening on the regular interval, which is called annuity payments. Example here will be this company signed 20 years building lease for 20 annual payments of $20,000, which begin immediately. Interest rate is 10%. Present value of the remaining lease is 167. It meets the two criteria, so it's considered capital lease. What will be the journal entry that we have to do and how we going to get this calculation if you have to calculate this by yourself. So let me get this information first, and I quickly we're gonna go to the Excel spreadsheet, and I'm gonna show you the calculation for the lease. Again, I'm not gonna test you on this, but I still wanted to show you. Let me share my Excel spreadsheet again. And we're gonna start a new worksheet right from the scratch. This is our first condition. Sign the 20 years building lease with 20 annual payments of 20,000 beginning immediately. So what else we need? We need interest rate. We go back to the Excel. And this is the other information. So what I'm gonna do is I'm gonna get this part and only this part, and I'm gonna work on this one with some small modification. That will be a lease here. Worksheet, we're gonna call it lease. So we're gonna have different things. First, obviously there will be no future value. This future value is gonna be disappeared. There's no interest on the bond, on the lease, so, but we're gonna have the interest rate only on the lease. And our interest rate here is 10%. Annual payments and anything like that, we can, so the annual payments, there's nothing here. Payments per year is only one payment per year, and we paying every January, usually January 1st. Let's keep it simple. This line will disappear. We don't need it. Our payments are 20,000 at the beginning. Payments per year at the beginning of the year. Maturity, the lease is for 20 years. After 20 payments is gonna be gone. Payment interest, payment to maturity years. No, let's get rid of this. Payments, annual payments. Let's go with this annual payments over the period of lease. Over the period of lease, and those are 20 payments. 20-year, 20 annual payments. Interest, we have it. The interest, those two lines are useless for us. We don't need this one. That will be our I slash Y. Let's make this one different color, more like blue, green, and this one like this, and this one like that. As you can see, very simple than the previous one. Delete, we're gonna move those one up. So what we need is to get the present value of the lease obligation, value of the lease liability. At the end, what we have to pay? We have to pay $20,000 20 times, and interest rate is 10%. That's what we have to pay. So now let's go to the present value of the formula, going the formulas, going to financial, scroll down to the present value PV. And now we start plugging the information. Rate is 10%. Number of the periods, 20. Payment, we have to make that payment. Negative $20,000. Future value, there's no future value, that's 0. Now type, that's where the interesting part is here. That's why I wanted to bring this to your attention on the calculation of the lease. The type is the key here. And as you can see here, it's a logical value. Now the payments at the beginning of the period, enter 1. If the payment is at the end of the period, enter 0 or don't do anything. Now the question is, when we're making the payment, at the beginning of the period or at the end of the period? And what you have to remember is on the lease, we always make the payments at the beginning of the period. What that means is, in this formula here, in this setup, you have to enter 1. And then click OK. And you're gonna get the present value of the lease liability is that much, $187,298. Now, once we deduct the firm less the first payment, which first payment is 20,000. As we already know, the first payment is exactly 20,000. So after the first payment, on January 2nd, our lease liability is this one minus that one. And this is the present value of the remaining lease payment, as you can see here. The present value of the total lease payment is 187. Once we deduct the first payment, which we're making on January 1st, then our liability is going to go to the amount of the remaining balance of the payment. Make sense? So now I want you to see something. If you make a mistake, what will be the difference? So let's get rid of this and let's go to the calculation again. Formulas, financial, present value. And let's go. The rate is 10%. Periods 20. Payment, we're going to pay 20,000. And on the future value is 0. Type. Let's assume just for a second that you forget to do that type and you do nothing. Then you're going to have a huge difference. It's a one present value. If you make the payments at the beginning of the period, is completely different present value if you make the payment at the end of the period. So be careful with the calculation, and on the last section, always enter 1. No, this is the 0 here, comma 1, and that's how it should be. And that's how we're getting this number. So be careful with this calculation, please. Remember, for the lease, it's everything is at the end of the period. So the journal entry, what will be the journal entry? We're gonna get debit. We're gonna have, let's go debit here. Debit asset on the lease. And the value of the asset on the lease, it's gonna be, let's go home and let's go this one. Asset on the lease, it's gonna be, the value is gonna be, trying to make those one bigger, equal to that one. Then we're gonna have lease liability, credit. Then we're gonna have here credit. Lease liability. Which lease liability is gonna be this amount. And don't forget, this is on January 1st. And don't forget, on January 1st, we have to make the first payment, cash, which is $20,000. And that's how we balance the entry. We made the cash $20,000, we calculate asset on the lease, what's the value, and we get the lease liability. Let's go to the slides. And as you can see, again, we have asset under lease, in this case is building under capital lease. Cash, we're paying the $20,000 right away. And lease, capital lease liability of 167, the remaining. Now, what's going to happen now with this? What's going to happen period after period? Every period, we're going to calculate amortization expense, which amortization expense will be based on the remaining balance, the balance of the asset divided by the number of the payments, and we're going to get the amortization amount, and we're going to start amortizing that building under capital lease every year, because once at the end of the 20th year, we stop using the asset, so we have to transfer all the what will be that? All the value of the building into the expenses as amortization. The other thing that we have to do is we have to show the interest expense. Why we have to show the interest expense? Because this lease is a lease liability. So we owe $167 to $98 every year, the first year. Over the year, we owe 10% interest, so we have to show the interest expense. So let me show you quickly on the Excel spreadsheet how this is going to work. So again, we have to do this Excel spreadsheet calculation with the chart, which I'm going to do it for you. Again, this is optional now. From this point, it's optional. You don't have to do anything. I'm not going to test you on this. It's still way too early for you, but I want to give it to you because I'm not sure if I'm going to teach intermediate accounting second part. So if I don't catch you there, at least you will have this information here available, and the beauty will be on the Excel spreadsheet, so you can use this chart later. So what we're going to have? We're going to have the periods. And starting with the period 0, 1, and 2 and all the way to period 20. Like here, period 20. We have those periods. During those periods, what we're going to have is we're going to have balance. We're going to have payment. We're going to have the interest expense. We're going to have difference. And we're going to have a lease liability. In the very beginning, very beginning, our lease liability was equal to the present value of all the future payments. At the end of the period, lease liability has to be 0. This is common sense. That's how it should be. You shouldn't be questioning this logic. Now, the payments over the lease, we have to pay exactly the same amount. So every period, so that's year 2. So that will be, so this amount is going to go right here on the period 0. Every period, we have to pay 20,000. Make sense? Let's add another column. I'm going to add another column. That will be adjusted balance. Payment. And those payments going to continue every period. 20 payments. We have those payments. There will be no questions about it. Now, this balance, the beginning balance, is the balance that we're going to have before the payment. So that balance is going to come here. Once we make the first payment, then our adjusting balance will be that amount minus the payment. Now, on this amount, since that's going to be outstanding from January 1st all the way to December 31st on the first year, we owe interest, which interest is at 10%. So I have to calculate how much is the interest. That will be this amount times 10%, and I'm going to log those 10%. And that's my interest the first year. Now, difference, I don't think I need this column difference. But let's leave it for now. And then my lease liability, my new lease liability, is going to be equal to the adjusted balance plus no, I still need the difference, plus the difference. But this difference is going to come from the payment minus the interest expense. So the next period, my balance is that much. My adjusting balance is going to be the beginning balance minus. This is my outstanding amount from the beginning, January 1st to December 31st, which I owe 10%. And that's my difference between the payment and the interest expense, which is going to increase my lease liability. And I keep going the same direction. Let's put this one all the way down. This one will be that one. Then we're going to have the interest expense. Then we're going to have the difference. And then we're going to have the lease liability amount. Is that the way? No, that's not the way. So basically, this difference doesn't work here. That will be 0. Let's move it 0. And my objective is to get here to 0, going down to 0. So that will be equal to, let me double check something. This entire interest expense is going to increase my lease liability. That's going to be equal to this one plus the interest expense. And if I do this, still going up. Adjusted balance. No, I'm wrong here, people. Interest expense. This liability going down. Interest expense gonna increase it. That doesn't make sense. Something's just a second. Let me check my formulas. So this one is here. This one go, I think here, 167 equal to this one. Sorry, this one plus that one. That will be my interest expense. That's how it's gonna be. And this should bring me down to 0. There we go. Sorry for this confusion. So basically, how it works. Lease liability balance in the beginning is that much. Once we make the first payment, adjusted balance become the outstanding minus 20,000. Then we have the interest expense at the end of the year, which increasing our lease liability. And on December 31st. And on January 1st, we're making the $20,000 payment, which reducing our balance to the new amount. Again, at the end of December 31st, we are accruing the interest, which increasing the liability on December 31st. And on January 1st, we're making the payment of 20,000. And we keep going, keep going, keep going. And at the end of the 19 payments, on the year 19, our balance will be 38,181. Once we pay the $20,000, balance gonna become 18,181. The interest, when we're adding the interest of that outstanding amount, 10%, is gonna give us exactly $20,000 outstanding balance on December 31st, which we're gonna pay on the January 1st. And that's how this schedule is. Now, if you have to recreate this schedule, don't make the mistake that I made. I don't need this column. I can delete this column completely. Let's get rid of this. And now become something that you can use later on in your journey in accounting for the lease liability, calculating the lease liability by knowing that the end of the period has to be 0. Don't forget, beginning balance is the original balance. Once you make the payment, balance decreases. Adding the interest expense to the outstanding balance liability and make another payment. And keep going, keep going. At the end of the period, it's going to be end up with 0. Now, you can shorten the periods. It doesn't have to be 20, but if you shorten the periods, this amount's going to change. Make sense? That's what I wanted to show you. Let's put this one in the chart, and you have this calculation. Don't forget, the payments never change. And objective is to bring the lease liability down to 0. Okay, that was with the lease liability. Let's cut it from here. And let's go to the slides and finish this chapter. Again, with the interest expense, every time at the end of the year, we're gonna accrue the interest expense into increase of the liability. We're gonna show the interest expense as expense. On the credit side goes to increase the lease liability. And eventually, you're gonna go down to 0. The difference between the International Financial Reporting Standards, once you see the International Financial Reporting Standards, the appendix is for time value of the money, which we already covered. Now, the only thing that that if you want, if you're interested, on the time value of the money of those slides, what you can do is to use the financial calculator. This is the chart how to use the financial calculator. But if I catch you in the class, I can show you the financial calculators later in your study in accounting. So far, you know the Excel. If you know the Excel, you can easily do the Excel. But if you need the BA Plus calculator, which is the Texas Instrument BA Plus calculator, which is provided by CPA on the CPA exams, you can use the calculator. Don't forget, in the CPA exam, you also gonna have available the Excel spreadsheet. So once you know the Excel spreadsheet, that's okay. And that will be all for me from today. Questions now?
No, I think I will see the video again.
Okay. I think become a very nice video. At least I try to go very slowly on the bonds so you can understand the bonds. I'm gonna post you again. I'm gonna send you the Excel spreadsheet once the video is done, and you're gonna have both the video and the Excel spreadsheet.
Thank you, Prof.
Make sure you finish your assignments, and next next Saturday, we're gonna talk. I'm gonna give you some idea about the midterm. We can go some questions over the midterm, and after the lecture, the midterm is gonna be available for you.
Okay.
Okay, guys. Thank you for today. Enjoy the rest of your day. Don't forget tonight to turn the clock back 1 hour. So you're gonna have extra sleep or 25 hours day tomorrow.
Thank you, Prof.
Thank you, guys.
Thank you,
Thank you,
Professor.
Prof.
Thank you.
Thank you, Professor.
Thank you.
Bye. See you next week.
Bye. See you next
Prof.
week. Yes.
I was sick this week, so I
Okay.
didn't email you, but probably I will send you an email today or Monday. Is it okay?
Okay. Yes, that's okay.
Thank you,
Totally fine.
Professor.
No worries. Get
Perfect.
well. Get well.
Thank you.
You're welcome.
Bye.
Bye.
Tomorrow.